Holmes. It has been a busy few days in the financial markets and real estate world, and I wanted to catch you up. So let's talk about a banking and real estate update. There have been a few bank failures over the last 3 to 4 days. I want to talk to you about what happened. Is this 2008? For those of us who've been around for a while and have memories and scars from 2008, what's similar and what isn't? The quick answer is no, and I'll tell you why. And then let's talk about what's next for this market. So first, I think it cannot be overstated at this time that the current status is things have been stabilized by the Fed. The federal government has taken action that has helped stabilize the major concerns that we would have with the market. Most importantly, depositors have essentially had their risks of working with banks eliminated through the Fed's action. Investors have seen their risks reduced significantly. And when I say investors, I'm talking about the people who own the banks, shareholders of these banks. Their risks have been reduced substantially, but of the people that have risks of future issues with banking, it's the investors based upon how risky or not their banks were in this process. So let's talk about what happened here. So recent treasury bonds. So when I say recent, over the last couple of years, the treasury bonds are near guaranteed assets. Treasury bonds are investments that are backed by the federal government, and they are nearly guaranteed, as much as pretty much anything can be. They're one of the least risky investments that any person or corporation can make. Well, when banks wanted to invest their money so they could get a return on it and make a profit, they invested in treasury bonds. Now, those treasury bonds that they bought a year or 2 years ago came with a much lower interest rate than what interest rates are today. And when you hold a bond, when the interest rate environment rises, right? So interest rates today are substantially higher than what they were 24 months ago. Your current value of your older bonds, those lower interest rate bonds, the current value of that bond is decreased. Now, the interesting thing is the promise to pay back and the money that you're going to get over time is not. You're going to get all of your money, especially with a treasury bond. You're going to get all of your money from the federal government, but you have to wait to get that money. If you have to cash out early, that's when you have a lower valuation of that, and you might lose some money. The interesting thing is, the banks that have failed, most of them have had specialized risks. When you look at the banks, Silicon Valley Bank was a bank that specialized in working with venture capital and small firms. Well, venture capital money has dried up a little bit here recently, so there's been less funding to those firms, and those firms have needed to pull out more money than what you would typically expect firms to do in a normal environment. So Silicon Valley saw more people withdrawing money than what they expected, and because of some of the bigger risks that they took in the way that they were banking, they were exposed to that withdrawal more so than other banks who might have a lower risk profile or a more diverse portfolio of depositors. Now, you look at some of the other banks that have failed, what you'll hear is crypto, that there's a lot of folks where they were, banking for people who had crypto deposits, and cryptocurrency has seen another market decline there, and so you're finding that people were trying to withdraw more of their money. So that as well created risks in those banks. So in the end, if these banks were able to hold on to the treasury bonds that they had, that they would experience no loss. But because of the higher rate of cash out from their depositors, right? So people pulling back their money, right? They had to sell those treasury bonds and then realize these losses that put their fundamental bank at risk. So, the Fed's response. How did the Fed go out there? Initially, the Fed wanted to say that there would be no bailout for these firms, but what became of that is they recognized that not bailing these out would not only hurt the banks, who probably should be hurt for taking more risks than they should have, but it would also hurt the depositors who were uninsured, those who had more than $250,000 in the bank. And these aren't just wealthy fat cats, right? These were a lot of firms that used this money for making payroll and keeping the businesses alive. So the Fed went out there and said, here's what we're going to do. We are going to allow banks to borrow from the Fed. If they need to sell these treasuries early, we will allow them to actually just take a loan from the Fed at the face value of those securities rather than at the discounted value that they might have to sell them for today, which essentially has eliminated their downside risk there. They're able to still get money when they need to, and so they have stabilized capital, but it's also made sure that they're not going to realize billions of losses that would then create instability for their depositors, right? So this stabilizes access to capital for banks, which is what they need if their depositors come asking for their money, and it also stabilizes and insures depositors beyond that $250,000 threshold. So all of this is really great news. So we look at, is this 2008? And the fundamental answer is no. First and foremost, many of the regulations that were passed back in 2008 to help protect us have been providing protection. Now, some of those were loosened up back in 2018, and that's where the recent action of the Fed, having learned the lessons of 2008, taking very robust and proactive action here, have redoubled those protections and provided that stability. And the most important thing to look at here is the underlying bank investments are secure. The investments that we're talking about having gone bad for these banks here recently didn't go bad because they weren't going to be paid. Right? They were going to be paid. They just had to be sold sooner than what these banks had anticipated. As opposed to 2008, many of the investments that banks had made back then were actually going bad because they were founded upon, or the foundation of those investments were subprime mortgages and loans that never should have been made, right? So overall, this looks completely different than what it did in 2008, and the Fed's action here is something that has provided a great deal of security moving forward. So what's next? The first thing we want to recognize is that there's likely going to continue to be volatility. We've seen a lot of volatility in the last year or two as we've gotten out of COVID and are trying to stabilize the overall economy, right? The thing that we can rely upon is depositors are going to be secure. So that's going to help stabilize that volatility. Where we're going to see more volatility is investors in banks. As we look a little bit more closely at banks' balance sheets and their risk profiles, you could see some banks have significant losses to their stock valuations, not necessarily going under or creating any instability for their depositors, but people might start taking a closer look at all these banks' balance sheets, which is exactly what happened with Silicon Valley Bank. So what we also might expect to happen is the Fed might actually pause their rate increases on this just to help create more stability here for the overall market. And we could see a return to interest in bonds over stocks. Bonds have been hit pretty hard over time, and why we like bonds rising in real estate is that the more that bonds rise and the more faith there are in bonds, the more we see stabilized mortgage rates and decreasing mortgage rates. So of the things in the folks that we're listening to and we're hearing from, which I try to not only listen to the people who I like, but also the people who are telling alternate stories, right, and challenging opinions. But what we're seeing here is that most likely this is going to help boost the bond market, and that is going to help the mortgage rates, both short-term and long-term. So when we talk about where we can talk more about this, we have Sips and Tips coming up. It's going to be focused on 5 keys for selling today. So if you're thinking about selling in the upcoming spring and summer market, we'll talk to you about the 5 things that you need to know to have the greatest chance of success in that process. It's going to be Tuesday, March 28th, so 2 weeks from today, and it's going to be at the Wicked Wine Social Club in downtown Everett. And of course, as we do with all of our Sips and Tips events, we're going to give you the very latest economic data, latest inflation data, latest mortgage data, so that you can be the most informed buyer, seller, homeowner, or just a citizen of your community. So we encourage you to come out and join us for those events. And I encourage you to send me a message, send me an email, a text, a phone call if you've got any questions about what we've talked about here today. More than anything, I hope that you have faith in the market here. It's not 2008. Things are much more stable than what they used to be, and there are opportunities in the market out there for you. Thanks for watching, and we'll look forward to talking to you soon.